One of the main goals of all dividend growth investors is to live completely off the dividend income that their stocks or ETFs generate on a consistent basis. And of course, from there, quit their job and entirely retire and live out the rest of their life on their own terms. At the exact point where your dividend income crosses over the amount of expenses you have on an annual basis, you are essentially financially free. Now, the problem with traditional dividend growth investing is that most of the popular traditional methods of buying into high quality assets like SCHD or even the S&P 500 is that it could take many years until the dividend income gets to a point to offer the investor financial freedom. But in this video, we are going to analyze a new non-traditional ETF that has somewhat of a crazy strategy, but might just allow investors to reach financial freedom much faster. And on top of that, I'm going to show you exactly how just $50,000 invested into this ETF could allow almost any investor to reach financial freedom much faster. Now stay tuned because we are going to go over all this and more. Ready for you, please drop a like in this video and subscribe for more future content like this. Now, before we dig into this new ETF and go over the math, there's a few things that dividend investors are going to want to focus on when it comes to trying to get to a point to where their dividend income crosses over their expenses and allows them to retire early. Now, two important metrics I'm talking about is first dividend yield and then dividend growth. Now, dividend yield is a financial ratio that tells you the percentage of a company's share price that it pays out in dividends each year. For example, if a company has a $20 share price and pays you $1 per year, then its dividend yield will be around 5%. Now, for those that are looking to retire early with a relatively small amount of money, they are going to need to find either stocks or ETFs with a rather high dividend yield in order to stretch out the dividends much further. Now, the other metric I mentioned is dividend growth. Dividend growth is a substantial increase in the dividend payout by a company to its shareholders from one period to another, compared to the dividend payout of a previous period taken, generally calculated every single year. So for example, if a stock or ETF pays out a $1 dividend per year, and the next year it pays out a $2 dividend, well, in that case, the dividend growth rate would be 100% because the dividend doubled from one year to the next. Now, the ETF that we're going over today, SVOL, does not necessarily have an impressive dividend growth rate, but it does have a very substantial starting dividend yield, which is why I think it's a perfect candidate for this thought experiment. So SVOL, or the Simplified Volatility Premium ETF, is an ETF with a starting dividend yield of around 16 or 17%. A very nice historical track record for dividends paid, and is even up in the green as far as year-to-date return as far as ETF price. But looking into SVOL, or the Simplified Volatility Premium ETF's fact sheet from the investor website, it says SVOL seeks to provide investment results before fees and expenses that correspond to approximately 1/5 of the 3/10, the inverse of the performance of the S&P 500 VIX, or short-term future index, while also seeking to mitigate extreme volatility. We believe that many traditional sources of income are failing to meet investors' needs in today's low-yield environments. SVOL aims to provide an attractive income stream and source of diversification while seeking to avoid risks inherent in other income-producing asset classes. The fund's short VIX positions provide investors an optimized exposure for monetizing the premium in the VIX future markets. A modest option overlay budget is then deployed into VIX call options to help protect against adverse moves in the VIX. So some key points for this ETF. It says first, ETF providing inverse VIX exposure coupled with a dynamic hedge. 25% short VIX exposure helps to balance trade-off between high income and volatility drag. Deep out of the money VIX call options seek to provide low cost protection against an extreme move if the VIX spikes, and monthly distributions and no Schedule K1. Everything so far seems pretty good. So for those that maybe aren't aware of what even the VIX is, the VIX is a ticker symbol of the popular name for the Chicago Board Options Exchange CBOE Volatility Index, a popular measure of the stock market's expectations of volatility based on the S&P 500 index options. So the VIX is used to measure a level of fear, risk, or stress in the market. When there's more of those things, the VIX shoots up. Traders can also trade the VIX using a variety of options and exchange traded products like VIXY or even UVXY. The VIX generally rises when stocks fall and declines when stocks rise. So simply put, the VIX sort of trades the opposite of the market. If the S&P 500 is very green, you can expect the VIX to most likely be in the red, and vice versa. Now, SVOL's portfolio is fairly easy to understand. It is short around 20 to 30% of VIX short-term futures, while owning treasury bills to generate additional yield on idle cash. and it spends about 2 to 4% a year on tail hedges to protect against black swan events or simply put massive swings to either direction. Investors should also note that SVOL ETF may occasionally change up its portfolio by buying short-term corporate bonds or hedging with calls on other instruments like the ProShares Ultra VIX Short-Term Future ETF or UVXY. Now, to learn a little bit more about SVOL, let's head over to the Simplify ETF website. The fund overview says it has a gross expense ratio of around 0.66%, which is definitely on the higher end, but for an actively managed fund like this, that's not all that surprising. The total assets are around 334 million as of right now. The distribution frequency, which we are going to go over later, is monthly. And the distribution yield as a last is around 17%. And since the inception of this ETF, SVOL is down around 10% or so as far as ETF price. Keep in mind the expense ratio is 0.66%, but the dividends that SVOL has paid so far since the start of this fund have definitely made up for some of the loss on the ETF price. Looking at some of SVOL's monthly paid dividends historically, we're talking 30 cents, 32 cents, even as high as 35 cents or 39 cents per share on a monthly basis. Now again, since SVOL is relatively new, we don't have all that much historical data to go off of, but to give you an idea, SVOL is up around 16.78% as far as total return goes on the 365-day time frame. And with the starting dividend and the consistent amount of dividends paid so far, I would personally say that this ETF might have something going good here. But now for the fun part, to show you exactly how much an investor would earn consistently off of a $50,000 investment into ticker symbol SVOL and $0 contributed from there. With a starting dividend yield of 16.87%, zero expected annual dividend amount increases, even though in the future it definitely could happen, and 0% expected annual share price increases over a 30-year time frame, with dividend reinvestment turned on, which means that investors, in theory, would be reinvesting all those big juicy dividends back into more SVOL consistently. Let's see what we would get. So for the first year of this investor buying $50,000 of SVOL, going off of the current metrics, this investor would already receive around $9,100 annually in dividends because, once again, that massive high starting dividend yield. By year number 2, after those dividends are reinvested, this investor would receive around $10,500 in annual dividends. Again, this is with a $50,000 invested amount in SVOL, not a single dollar more, just the dividends reinvested. By year number 3, a $66,000 principal of SVOL, and over $12,000 already per year in dividends. That's over $1,000 per month, which still isn't necessarily enough to live off of and quit your job, but we're going to see how the power of compounding takes place and how those reinvested dividends really start to bulk up the numbers. By year number 5, $16,000 worth of annual dividends. Now by year number 8, 9, and 10, we're talking $25,000, $28,000, $33,000 per year in annual dividends. Now by this point, it might not necessarily be enough for you or I to live off of, but we're getting very close, and we're even getting in the range of what an annual salary is for most starting jobs. Now by year number 12, 13, and 14, we're talking $44,000, $51,000, and $59,000 per year in dividends. Now at this point, this is crossing over many people's annual salaries, and at this point, some investors would be able to, in theory, quit their job and live off the dividends moving forward. And just for fun, moving further and further down, by year number 16, 17, 18, we're talking $80,000, $90,000, $100,000 per year in dividends paid. Now at this point, the majority of people will be able to quit their job. So in theory, if a 25 or 30-year-old invested $50,000 into ticker symbol SVOL and let the dividends do their thing, basically never touch the portfolio, just let all dividends reinvest, going off of the metrics that we have here, a dividend investor in theory could at this point most likely quit their job. Now the math gets crazier and crazier because the dividends paid are getting bigger and then reinvested, of course. So by year number 25, we're talking $290,000 in dividends per year. And by year number 30, if an investor bought into SVOL for 30 years straight, we're looking at almost $600,000 per year in dividends. Now, of course, take all these numbers with a grain of salt. The amount of dividends paid consistently from SVOL could change because, after all, the Simplified Volatility Premium ETF is a rather new ETF, and again, we don't have all that much track record to go off of. But to be fair, it's very interesting to look into the actual math of what a rather high starting yield dividend paying ETF with a relative small overall amount of money invested into it. But I want to hear from you guys down below when it comes to these non-traditional ETFs, like SVOL or even other covered call ETFs. Are these the types of ETFs that you're personally adding into your portfolio as of now? Let me know down below why or why not. I personally am interested in buying some shares of SVOL moving forward here. And simply put, this is because of the track record that the ETF has had as of this far. The ETF has proved to do pretty well in multiple different market conditions, and the monthly distribution as of this far has been very, very impressive. On top of that, the ETF's price has not decayed substantially, which is my biggest pet peeve of super high yielding ETFs or stocks. Most of the time when they're distributing north of 10%, you're going to see the price decay significantly. But honestly, over the last year at least, SVOL has pretty much had all the good parts of super high yielding stocks or ETFs and hasn't really shown many of the bad parts. If you enjoyed this video, make sure to please drop a like down below and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.